Now, these are 3 things you need to do before you start investing. Otherwise, you stand a higher chance of losing money. Now, if you think I'm going to talk about pay down debt, get ready your emergency fund and things like that, you are wrong. Okay? You are wrong. Okay, because all these things, they are good, but all these things is only if you lose money in your investment. You make sure that you still got a roof over your head, your children still can go to school, and your wife don't kick you out of the house. But it actually doesn't help you make money. So you understand these 3 things that I'm going to talk about today, right? Then at least it sets you up for potentially greater gains in your investments. To do this, right, I'm going to tell you a story. But before we start, you need to know that as of today, 25th of March 2024, Facebook's price is at $509.58. Because the story is actually about one of my clients who actually bought Facebook at half the price it is today, and yet still lost money because he did not do these 3 things before he started investing. And so my client, right, he actually bought Facebook at about 240, 250, somewhere around there, after it dropped from the 380s lah. And actually he didn't tell me, this only came up, right, because I saw Facebook at 180 something, and then that was when I started to get interested, and I was just sharing with him about it. And he expressed surprise that it actually dropped by over $70, you know, from where he bought it at. So as we were talking over the months, actually he held it all the way through. And unfortunately for him, he buay tahan, because when he saw the price around 130 in the 120s, he actually sold it, and then he moved into so-called safer investments and actually parked his money inside T-bills. And so what we can learn from this, right, the first mistake that he did was that he didn't have a clear understanding of his time horizon and his investment goals. Because when we invest, right, you actually need to choose the correct investments that match your time horizon and goals, you know. You cannot tell me this is money that I need 1 year later, and then because you hear someone say, wow, China 2024 very hot, then after that you put all your money into China hoping next year you can take it out at again. If you need the money in the short to mid term, then the best thing you do is you get some short-term savings plan, you put into T-bills, something that is very slow and stable, that you know the money will be there in the short to medium term. And of course, if you have more than 5 to 10 years of time horizon, then of course you can look at equities and stocks and things like that, because all those things generally will give you a higher return, but you really need a long time for that to play out. You see, by moving his money from Facebook to T-bills, right, what he was actually doing is moving his money from a capital appreciation asset into a capital preservation asset. 2 completely different asset classes with 2 completely different intended investment outcome. The thing is, he actually don't need the money, you know. How I know? Because today the money is still in T-bills, what? But the problem is because he lost 50% heart pain already, so he take out and put into safer investment. So unfortunately, T-bills so far, now will only make back about 7-8%. So every time I meet him, he like to ask me, so what is Facebook price now? I tell him, don't ask you ask, you heart pain, I also heart pain for you, you know. Because if he had held on to it, today he would have doubled his money already. And so that's why understanding your own time horizon and investment goal is very important, because otherwise you get emotional. That's number 1. Number 2, you end up choosing the wrong investment tools to use for your own investment. That brings me to my second point. You see, in theory, we know buy and hold, right? Everybody thinks that they can hold their stock for a very long time. That is until you see your net worth drop by more than 50% in less than a month. You just imagine you spend 5 years saving up all that money to invest, and then after you invest, within a month or 2, something bad happens in the market and half of that is gone. 2.5 years of your savings paper loss. Paper loss lah, not real loss yet, but your heart still pain ma. And so Mike Tyson always said, right, everybody has a plan until they get punched in the face. And in investing, it's not any different. So the second point is that before you start investing, it is very important for us to have a conversation with ourselves about our risk tolerance. And to be very frank, right, actually I don't like the word risk tolerance. I think it is a misrepresentation of what we are trying to say. Actually, it's not risk tolerance, it's your ability to stomach volatility in the markets. When my client moved his money from Facebook to T-bills, right, at least to me, he wasn't necessarily making a safer investment. Now, I know this may sound a little bit counterintuitive, and I'll explain why in another video. But just hear me out for a moment. He was actually making a less volatile investment. You put yourself in that position, you actually just lost 50% of your portfolio. And so what are you worried about? You're actually worried, right, that what if it continues to drop and I left with only 40, 30, or even 20% of my portfolio? So while trying to prevent that, the fear of trying to prevent that from happening caused him to move his portfolio from Facebook into T-bills. The truth is, right, many of these big companies that we consider blue chip and and safe, right, if we look at the historical price action, right, we can see that there's actually a lot of price volatility all the way through the years before they became considered as a blue chip stock. So if you're unable to tahan all this volatility over the years, right, then this kind of investment may not be for you. But it's exactly like you go to USS, right? If you know you cannot take the roller coaster, no matter how your friend beg and pull you, you will say, no, I sit here, I take care of your bag, I take picture for you when you come down. That's about it. But the truth is, right, if you go to USS, there is also, for people who want, there's also the option for you. You don't want to take the Mummy, you don't want to take Cyclone, you can still take the far away, the pink color dragon roller coaster. In the same way, if you cannot tahan so much volatility, you structure your portfolio such that there's less volatility lah. But you adjust your expectations along the way, lor. You know that, hey, maybe my return's not so high, maybe I need a little bit longer in order to hit my retirement target, and that's perfectly fine, right? Because it's personal finance. Everybody has to do what is best for themselves. That brings me to my third point. You see, people are going to ask me, hey, then how do I know whether or not my company is cui one, or whether or not I can hold on because it's just price volatility? You see, whether or not you are DIY investing or you choose to go through robo-advisor or your financial advisor, I actually think it's good for you to have some basic understanding of what is happening. You see, when you equip yourself with the correct knowledge, right, then at least you have some sort of baseline to assess whether or not other people's investment philosophies are in line with yours. The tools and the people that you choose to help you are in line with your own investment philosophies, and you can also better assess the risk. At that point, right, the robo-advisor or the financial advisor, their job is actually just to offer you a second opinion and help you automate the process along the way. You see, risk is actually whether or not the economy is doing well, whether or not your company is making money. Right? Risk is not hey, the price go up, the price go down. That one is called price volatility. Totally two different things. But the thing is, when I have conversations with my clients, right, a lot of them tell me, hey, when I ask them, why you buy this stock, they tell me, oh, because I see the price here. Today the price is here. So when it goes back up, I will make a lot of money, lor. But the thing is, do you know that not every single stock, the stock price will go up? You see, there's this very big company, right, or relatively big. We actually see them everywhere. Sometimes you see them in schools, we see them in shopping centers, or even when you cross roads. 24 years ago, right, they actually hit $82. But after hitting $82, their price dropped 90%. And even up to today, they only recover about half the value. Coming back to the story, right, when my client bought Facebook at $240, his only reason was because it's going to go up to $380, lor. So when it doesn't go up, naturally he'll be inclined to sell. But whereas for me, when I saw it at $240 or even at $180, I bought Facebook because I knew that, hey, the company actually made some mistakes in the past. They actually already made some changes to the company to rectify these mistakes. So I wasn't worried going forward, no matter how low the price drops. All investment comes with risk. One, low risk doesn't mean no risk. But what you can do is you can mitigate it by understanding what you're investing in. And of course, all this will only work, right, if you're able to choose the correct investment tools that suit your risk appetite and your time horizon. And so we talk more about that in this video over here.